compared to traditional closed-end funds. We have a wonderful lineup of panelists for you today. Just a reminder that the event is accepted for 1 CFP credit, so if you were interested in that, please contact us after the webinar. Right now, I'd like to introduce your panelists. We have Greer Eliasek, President and COO of Prospect Capital Corporation. Mr. Eliasek is President and Chief Operating Officer of Prospect Capital Corp. And a Managing Director of Prospect Capital, Management of PCM and Prospect Administration. He also serves on the Board of Directors for Prospect Capital Corp. At Prospect Capital, Mr. Eliasek is responsible for leading the Prospect team of professionals in the organization and assessment of investments. Prior to Prospect Capital, Mr. Eliasek served as a Managing Director with Prospect Street Ventures, an investment management firm which, together with his predecessors, had invested in excess of $1.5 billion in senior loan, mezzanine, bridge loan, private equity, and venture capital structures through publicly traded closed-end funds and private limited partnerships. Okay, next we have for you John Cole Scott, CFS, Portfolio Manager, Executive Vice President of Closed-End Fund Advisors. John has worked at the firm since 2001. He sits on the firm's investment committee and holds the FINRA 66 license and the Certified Fund Specialist designation. He's a graduate of the College of William & Mary and has been quoted widely in the financial press and presented at conferences and for investment groups on more than 40 occasions. In 2008, John founded CFA's Closed-End Fund Universe, a comprehensive weekly data service covering 165 plus data points for all U.S. listed closed-end funds and 100 plus for BDC funds. He's also founded and manages the CEF Network Group on LinkedIn and is editor of the firm's blog. John is a board member of the Richmond Association for Business Economics and serves on the investment committee for the New York State Society of Cincinnati. We also have with us today Greg Felton, Managing Member and Chief Investment Officer of Full Circle Advisors. Greg Felton is their Chief Executive Officer and President and is primarily responsible for overall investment strategies and portfolio management. Mr. Felton is also a Managing Member and Chief Investment Officer of Full Circle Advisors and a managing member of Full Circle Service Company. Mr. Felton joined Full Circle Capital in November of 2013. Prior to joining Full Circle Capital from 2006 to 2013. Mr. Felton was a partner and managing director of Goldman Sachs and the founder and chief investment officer of Liberty Harbor, Goldman Sachs Asset Management's credit alternative platform. He oversaw various investment vehicles, including hedge funds, mutual funds, and institutional managed accounts, and facilitated the launch of Goldman Sachs Business Development Company, Goldman Sachs BDC. From 2009 to 2010, Mr. Felton was head of credit for Goldman Sachs Asset Management, overseeing approximately $60 billion in assets. Prior to joining Goldman Sachs, Mr. Felton was a senior portfolio manager at Amaranath Advisors, a multi-strategy hedge fund located in Greenwich, Connecticut. He led Amaranath's global corporate credit investment team from 2000 to 2006. Prior thereto, Mr. Felton was a vice president at Chase Manhattan Bank, where he served as a portfolio manager and senior analyst for Chase Special Situation Fund. Mr. Felton began his career in the high-yield finance department of Chase's Global Investment Bank. In 2013, Mr. Felton partnered with an investment management firm to fold Altus Power America, an investment vehicle that focuses on solar power generation assets. In addition, Mr. Felton serves as director of Rye County Day School. Mr. Felton's broad experience managing investment vehicles and funds provides the board of directors with industry expertise and a valuable perspective on a variety of credit transactions. His education is Bachelor of Tufts University in 1992, J.D. Georgetown University Law Center in 1996, and he received his MBA in Georgetown University School of Business in 1996. And last but not least, we have Mr. Aaron Peck, Chief Investment Officer and Chief Financial Officer of Monroe Capital Corp. Aaron Peck is Chief Investment Officer and CFO of Monroe Capital Corp., a publicly traded business development company and Managing Director of Monroe Capital, a private investment firm providing financial to middle market companies. Mr. Peck has over 19 years of experience in credit lending, high yield, and public company operations and investor relations. Prior to Monroe, Mr. Peck was Chief Investment Officer at Deerfield Capital Management and was responsible for all the investment teams at Deerfield, including syndicated and middle market loan teams managing over $5 billion in assets. As well, Mr. Peck was Chief Portfolio Manager at Deerfield's publicly traded specialty finance mortgage REIT and in that capacity was the key point of contact for all institutional and retail investors, investment banking research and analysts, lenders, and investment bankers. Prior to Deerfield, Mr. Peck worked in leveraged credit at several investment firms, including AEG Investors, Black Diamond Capital, Solomon Smith Barney, Merrill Lynch, and ESL Investments. Mr. Peck earned his MEA with honors from the University of Chicago Graduate School of Business and a BS in Commerce from the University of Virginia McIntire School of Commerce. Without further ado, we'd like to begin the broadcast with Prospect Capital Corp. Greer?
Terrific, Patty. Thank you so much for that introduction. I'm going to move quickly to be fair to my fellow panelists. This is a panel about business development companies on their own, as well as compared to traditional closed-end funds. And I can't imagine a better time to be talking about BDCs as a potential storehouse of value than right now here in May of 2015. You have Goldman Sachs coming out saying the stock market gains are likely to be quite low over the next decade given recent gains and likely reversion to the mean, a powerful principle in investing. I think they're predicting 5% total returns over the next decade, half of which will come from dividends, and they're advising people to shift to dividends. BDCs, as some of the highest dividend payers around, look very attractive. Where else can you get paid 1,000 basis points over 10-year treasuries on a current cash yield dividend basis? And where else can you get and invest in at a significant discount to book value with double-digit discounts, the norm with business development companies right now? As you compare BDCs to closed-end funds, it's not that closed-end funds aren't also attractive, but on a risk-adjusted basis, BDCs compare quite favorably to closed-end funds. They're both floating rate, but you're going to be paid several hundred basis points more in yield with the BDC, with real covenant protection for the underlying middle market loans, and the discounts that are available right now are much greater for BDCs compared to closed-end funds. And I think BDCs will start to benefit as the Fed actually does and stops talking about hiking rates, and people will come to understand that BDCs are excellent vehicles to own as rates start to increase because they're asset-sensitive vehicles that are floating rate. And I'm going to dive in and go very quickly and tell you a little bit about Prospect along the way, and I'm on page 7 here of the presentation, Patty. So our firm is one of the largest business development companies, currently trading at a very attractive value, about a 22% discount to net asset value, a 12.5% dividend, which is a fully covered dividend at about 1,000 basis points over, again, 10-year treasuries. We fully cover that dividend out of taxable earnings. Again, one of the largest BDCs with more than $7 billion in capital under management. Quite diversified as well. We're really the only multi-line BDC that does everything from lend money to private equity-owned companies to buyouts. Over 130 portfolio companies. That diversity has continued to grow over time. And we also have a very low energy concentration. There's been some concern with BDCs in the last 9 months about exposure to energy credits, and we're on the lower end of our peer group. Significant senior secured focus and a very low non-accrual rate as well. A high mix of unencumbered assets. We've been an investment grade rated company, I think, longer than anyone else in the industry, and have enjoyed access to a lot of different types of financing in the bond market, many of which are liability structures that we've pioneered. And I would encourage investors to pay careful attention to the breadth and diversity in the terms of that financing. We've also recently announced we're looking at potential spin-offs to unlock value for shareholders for 3 of our businesses out of our multi-line approach, and that includes our structured credit business, online lending, and real estate. And you can see more about that in our public disclosures we also, as a senior management team, are some of the biggest shareholders around, and also have demonstrated support for the company from pretty significant insider purchases over the last year as well. So those are some of the highlights. I'm on to page 8. We've been a public company for 11 years, asset base of approximately $7 billion. With over 100 employees, we have significant scale from that standpoint. We use scale to our advantage. We're able to see more deals in the marketplace, work on more deals, close a larger number of deals to generate diversity, and also close larger deals, which give us competitive advantages in a marketplace where there are, I don't know, 3 dozen or so BDCs, most of which just have a couple $100 million of capital, and they're relegated to holding pretty small positions on a per deal basis. Again, the floating rate benefits are very important to understand. There's a lot of confusion about this with BDCs, where folks sell off high yielders thinking that's the right playbook whenever there's concerns about rates going up. It should be the opposite with a BDC. Buy more if you're concerned about rates going up, because 89% of our assets are floating rate and a similar percentage of liabilities fixed rate. So we expect to not only not get harmed by rates going up, but also benefit. We've grown our business substantially over the years. That rate of growth has moderated in the last year, which is good news from a shareholder perspective, because BDCs really can only grow their capitalization by issuing equity capital. Investors don't tend to be that excited about follow-on equity issuance. So we've already reached our scale, as opposed to others that are desirous of reaching scale and are maybe itching to issue equity. We have no such need or desire, and we can reinvest $1 billion plus of just exits, repayments, and runoff from the portfolio, and keep our originators busy in the open market. On to page 10. Pay attention to credit results for BDCs. Our non-accrual rate at Prospect is about 50 basis points, which is on the lower end of the industry. And of course, we've actually been through a full cycle. A lot of folks in the industry have gone public after the recession. Everything looks great after the recession. It's how did you do during recessions that's important. And that's a direct reflection of our credit discipline. Only 1 out of about 200 deals makes it through. On to page 11, we see thousands of deals per annum. Well diversified on the right-hand side of our balance sheet, 22 lenders in our facility, significant unencumbered asset mix. We invest up and down the middle market, $5 million EBITDA companies, $100 million EBITDA companies, and we'll look at all of them. Average is about $40 million. So on average, we're investing in much more well-established and lower credit risk private companies. On to page 12, you see the universe of business development companies, and it shows that we're one of the largest. And again, we have already achieved scale and reaped the benefits of same and how we run our business. Page 13 shows the growth of our asset base, but along with that has been the growth in the number of companies. So with scale comes diversity, very important de-risker in credit, diversity of name, diversity of industry as well. We've also grown, on page 14, our employee base. So we think we've grown responsibly, and we have plenty of folks to handle the scale that we've reached at all parts of the organization, from front office to credit to underwriting to portfolio management, as well as accounting and legal and tax, which are quite critical to our success as well. Page 15 shows the growth of our income. We've reached record profitability as measured by net investment income on a current and run rate and historical basis. Page 16 shows our dividend cumulative growth. Announced dividends for us now total about $14 per share, $1.6 billion of distributions. So we've paid a heck of a lot out in cash flows to investors, and expect for that to continue going forward. Sometimes folks see a high yield and they worry about dividend coverage. We did adjust our dividend in 2014, but the best time to feel comfortable is after an adjustment has been made as opposed to before. And we feel very good about our dividend and dividend coverage. Page 17 shows our performance over the last decade against other BDCs that have been public since that time period. Again, many have gone public really post-recession and haven't been tested. Page 18 shows our multi-line origination approach. I won't, in the interest of time, go through each of these, but we look quite different from other BDCs that really just do the top left box of lending money to private equity companies. We buy controlling interest in companies, operating companies, financial companies. We're the world leader in CLOs with about $16 billion of assets there, which would actually take our assets under management, including that business, to about $25 billion. We've got a big multifamily real estate business. We're a leader in the online lending business and partner with Lending Club and Prosper and Marlette and OnDeck and other companies in that space, aircraft leasing and syndicated debt. So that diversity allows us to be quite disciplined with how we're deploying capital and be in higher barrier to entry businesses that are less subject to commoditization risk as well. Page 19, deal flow is the name of the game, and we've been at this a long time, all the way back to 1988 with a very large team. We call on 800 private equity firms, more than 4,000 intermediaries. We're the only credit firm that we think is in the business that has a call center that sources deals. We see a lot of deals through the 300 management teams, past and present, that we've invested with, and just get a lot of deals because of our scale and having been in business for a long time. Page 20 talks about things we look for in underwriting, but the bottom line is, how do you do from a default standpoint, and our default rate has been near zero for quite some time. Page 21 shows the deal process, so-called how a bill becomes a law. It's generally a 2 to 6 months gestation period in which a very low percentage of deals make it through. Ours is a heavy lifting business. These deals don't get served up to us with a QSIP on a Bloomberg terminal. We get mud on the boots, feet on the street, and go out and create these opportunities on our own, which creates barrier to entries and alpha. Page 22, we brought to the industry, when we went public over a decade ago, best practice, where we fair value on an independent basis every single company on a quarterly basis, and that's approved by the independent directors with consultation from outside firms. And the rest of the industry has moved in our direction based on that example. Page 23 shows a decline in non-accruals that's continued now for several years. We expect our peak non-accrual rate during the next recession, whenever it is, 2 years from now, 3 years from now, 4 years from now, somewhere likely in that time frame, to be much less than the 5.8% from the last cycle, because most of that was project financing, a business we discontinued in 2007. And then on page 24, our weighted average portfolio yield is 12.4%, which is one of the highest in the industry. And that's because we're in higher barrier to entry businesses, buyouts, CLOs, online lending, areas that are yieldier and more attractive, we think, on a risk-adjusted basis right now than even the sponsor business. Page 25 shows some of the companies in our portfolio, quite well diversified by industry and name and geography. Page 26 shows some tombstones. We put out about $3 billion of capital in each of the last 2 years. Like to be a little bit less active here in 15, given the trading environment and situation. Somewhere in the $1 billion to $1.5 billion range is a little bit more likely. But you see we've closed some pretty scale deals that are difficult for others to hold size-wise. And we see activity picking up in the current environment. Page 27, well diversified by industry. No one industry is more than about 3 to 10% each. Page 28 shows we've got a very high secured lending mix. Majority first lien, 3/4 secured. Our structured credit book is all first lien paper. That puts the true first lien underlying mix at over 90% of the asset base. Page 29, a lot of repeat business through trusted relationships, sponsors, lenders, intermediaries. Page 30 shows our diversified liability stack. We pioneered the convert market in our industry. We pioneered the institutional bond market. We pioneered and the only company that issues weekly program notes that may be familiar to folks as well. You can buy those through In Capital, our Chicago-based wholesaler. And we've been optimizing our financing. We just called a baby bond, and we've called other bonds as well, and are issuing attractively and accretively at the present time. We've got a large team that's been at this for a long time. I co-founded the business along with John Barry more than a decade ago. Our CFO has been with us for 7 years, and a lot of our senior team's been with us for a decade plus at this point. So those really are the highlights about our firm, and if you have any follow-up questions after this webinar that we don't get to, feel free to reach out to our company directly, to myself, Michael Simony, our Head of Investor Relations, Nish Almeida, Head of Capital Markets, and Brian Oswald, our CFO. Thank you, Patty. I'll turn it back over to the next panelist.
Okay, thank you so much, Greer. So right now we'll move on to John Colescott of Closed End Fund Advisors.
Yes, so we are unique in this panel in that we really research and analyze BDCs, the whole neighborhood. Feel free to go to my next slide. And so we've been covering closed-end funds for a long time, BDCs actively for about 1.5 years. And conceptually, this panel has decided how to really focus on what BDCs are doing, because a lot of advisors and individuals really don't see them in the same light as other closed-end fund structures. So conceptually, a closed-end fund's fixed capital, active portfolio management, listed publicly with daily trading. We find them generally inefficient and somewhat volatile, but that's okay because the net asset values in the portfolios aren't volatile. That's just the market trading. And we find there's often out of sync patterns where certain funds either trade together but shouldn't be trading together, or trade differently and should be. And traditionally, the sector's been yield focused. We focus on the yield side of the business development company structure, but of course, total return, both from a net asset value perspective as well as a market price, is what's most important for shareholders. And all the things I said above, we've said for decades about closed-end funds. They're all true about BDCs. Couple of small differences. The leverage can be a little bit higher. Obviously, the guts are generally not liquid, which is the focus of the structure. It's not a new structure, just new to most investors. It was actually enacted by Congress in 1980. When I'm on the road with advisors, I say Congress did something actually useful that year. Let's go ahead to the next slide. So this is just a quick, it's going to be in the slide deck for folks, but just to make sure you know the difference between a closed-end fund and a BDC versus the other two 40 Act structures that are traded. Basically, ETFs are generally passively selected, though there's some smarter ones out there, and some, but they always typically trade in normal markets at net asset value, and they are an open-end structure in that as more people buy them, units are created, whether they're passively derived by an index or actively derived by a manager, and that's an open-end structure. And the more traditional once-a-day trading open-end funds, everyone gets the same price at 4 o'clock, which is fine, but we like to potentially get in at slightly better than average and get out slightly above average. Next slide. So this is the neighborhood, and just looking at, we combine closed-end fund and BDCs. Not many people do, but we find that they really work and act in many similar ways, and we think of them in the same way we approach closed-end fund investing. And really, our broad approach comes down to 3 broad principles. Is the manager performing well after their cost, NAV, total return, over time versus its peers and versus where it says it should be doing? Is the dividend repeatable, and is it more likely to go up than down? Because people typically buy closed ends and BDCs because of yields and sometimes because of discounts, so the yield's obviously important. And then the market price that you pay. One thing that's actually kind of cool about BDCs is because they mark about a 2 to a 4, 2 to 8 premium as a sector, as a group historically over time. Traditionally, right now, the sector, the debt BDCs are at about a 4 or 5 discount on an equal weighted basis. That there's really an opportunity to get this upside of the sector going back there. But when they're up there, they can usually do secondary offerings, which aren't very common in traditional closed-end funds because of the pricing. And it's a great way for for BDCs to come out and to grow their capital and add new investments over time. So there's 619 total closed-end funds, and there's about 50 for debt BDCs and 9 equity focused, and the market size is about just under 30 billion in the public debt BDC and just about 7 and change billion on the equity side. But the equity one is mostly driven by one large equity BDC. Discount levels, like I said here, it's a little bit wider than this slide, but about 3 and change for the average debt BDC. And the yields in the lower right-hand corner, the debt BDC is the second to last on the right. It's got the highest blue and green line. What I like about the red line, which a lot of people don't look at, but it's simply the leverage adjusted net asset value yield, which means for every BDC or closed-end fund, you back out discounts, back out leverage to get a rough back-of-the-envelope approach to what the manager has to do and his team to meet the expectations and the distribution policy set by shareholders. Go ahead and next slide. So just to make sure the discount's aware, a discount is below net asset value, a premium is above net asset value, and we think that some people give discounts a bad name, but discounts equal opportunity in our opinions. It's much easier for a discount to rise in historical relationships than for premiums to stay high for a long time. Next slide. So this is, again, looking at both the whole neighborhood of traditional closed-end funds, that dark line of where it's traded since we've offered our data and collected our data internally since 2012, versus the BDC sector, where actually when we didn't cover them back in 2012 because there's only 50, we could go back and get the whole universe historically speaking. And so right now, both groups are at discounts, but as like I said, generally it trades above. The average for the last about 3.5 years has been just under net asset value for BDCs and lower for traditional funds. But if you look at it in the late 12 and 13, before Bernanke opened his mouth in May, a lot of those were 2/3 of that were bond funds, which were at relatively high premiums historically. If we had the rights to data going back 20 years, I could show you a much cooler chart. But traditionally, BDCs are much more likely above book, and there was kind of an higher overflow available then in the 2000s. So right now we've seen closed-end fund discounts generally flat, and you can see BDCs, in my opinion, have jumped up about half of their rebound in this space. And as we look at the sector, the managers, and what we're seeing with the data, we expect, though it is a guess, that discounts as a whole should go away either at the end of the third quarter or fourth quarter, but really essentially once we have an earnings season, rates went up, and the earnings were relatively strong for the sector. Next slide, please. Just because people always wonder about how the yields get high, the only sector really where there's both leveraged and unleveraged versions of the similar things are not exactly the same as the muni bond market. So we're not talking about munis here, but Nuveen has this 4 similar each, and the yield is basically 1.6% higher just because they've borrowed. And the borrowing is a little bit higher for BDCs. What that means to us is that most BDCs borrow about 40 to 50% in normal markets, and regular closed-end funds typically are 25 to 40% of their assets. Next slide, please. And then there's that extra yield you get from discounts. So if you buy a premium, you're actually experiencing at the market price you paid a lower yield than if it was at a discount. So the discount, which many of the BDCs are at, or some are on small premiums, are still somewhat attractive. Here you get an extra 1 and change % just because the asset's trading below value. But remember, you got to decide, is the dividend repeatable, sustainable, and can it grow? And is the manager performance doing well over time? Because the discounts aren't the only answer. It's just, in our opinion, a third of the answer. Go ahead, next slide, please. So volatility. So BDCs, even though they are 40X structures, they tend to trade much more like regular operating companies, possibly because they file Ks and Qs like operating companies, partially because their assets are private and they can't easily be traded or understood by investors, maybe because they do an earnings call and an earnings release because they can only calculate net asset value 4 times a year versus most closed-end funds give you an asset value daily to the market. And so we feel that volatility, it's been a little higher in the last year than historically over time, but you can see the green lines at the bottom here. So debt-focused BDCs have a 1-year NAV volatility, which is a rather high year of volatility, somewhat higher than regular equity closed-end funds, and about double the bond side of the closed-end fund world. And so, again, some people hear volatility and get scared. Our firm hears volatility and gets excited because volatility means better chance for better entry point and better exit if you're patient and diligent and do your homework. Because there's only 40 debt BDCs, 40 and change, there's not a lot of coverage of them, and it's easier, and it's hard to be like a billion-dollar firm doing these things. They're liquid, but just there's not a lot of people doing it, so it's easy for FAs with a reasonable business, astute individual investors, RA firms like us in the space, I think do really great work. But the volatility is there, and you need to be aware of it. Next slide, please. So dividend changes, we cover this in our quarterly review call. This slide comes from that. People say, oh, dividend cuts are there, but there's, every sector has had cuts, every grouping, excuse me, not sector, and increases. And the thing is, over time, remember, boards set dividends based on the outlook, the economy, the portfolio, the discussion with their, investments, if their investments are like BDC investments, and changes happen. In the last 6 months, almost 50% of BDCs and closed-end funds changed the distribution policy. In the last rise of interest rates, which was 04 to 07, 97 or 96%, excuse me, of the funds changed their policy. Now, change isn't always down; it can be up. And so we do like to tell people, in a closed-end fund or a BDC, distributions are policies, not promises. People often buy debt BDCs or closed-end bond funds and think of them like a bond. They don't have coupon payments. It's not a default or pay and repay the loan. It's a managed asset, and the benefit is that with good management comes the ability to navigate the markets that happen daily that most investors and advisors don't have the ability to work through. Next slide. So just historically IPOs, there are more closed-end funds clearly, but if you look at the size, they average about 500 million in the last 5-6 years. And about 10 a year has been normal in the last decade. There was a big boom pre-crisis. There was a lag after that. I think that normal in that sector is probably about 15, 10 to 15 a year. When great years you get 20, and bad years you get 5. We see on the horizon this year, we're expecting about 7 to 8 closed-end fund IPOs this year. There's only one in the first quarter, but a very successful one in the convertible space. Next slide. Now, BDCs, in the last 10 years, there's been only 3.7 a year, and they've been much smaller. And the reason they can come out smaller is because they generally trade above book, so they can generally add equity once they're public, versus closed-end funds. In our opinion, and historically speaking, 9 out of 10, they get the capital in the front end, and then they might live forever, but it's unlikely they're going to be able to do a rights offer or a secondary raise. So BDCs can come out quicker, less costly, and scale up over time, and they can do that because they generally trade, again, as I said, above net asset value, which makes a secondary offer accretive and good for investors long-term to net asset value. Next slide. And this is the last slide we're going to talk about, and it basically looks, we like to look at the last 3 full quarters of closed-end fund and BDC IPOs, and we just look at how their discount to NAV is doing and how their price to IPO price is doing. And one thing I'll say is there's been some standouts in the closed-end fund space, but generally speaking, while some of the funds are trading off their IPO price, these funds generally trade, as it shows here, right around or much closer to net asset value. And it can change over various time periods, but that's traditionally what is normal and available for the sector. And so, with that, I'd say just some few quick comments on our approach to BDCs. Generally smaller exposures because they're a little more volatile. And we usually do 4% of the small allocation for a closed-end fund. We're more like a 2% for most BDCs individually held in a diversified portfolio. Though we do manage a portfolio of just 7 BDCs right now that we've made convicted bets on managers. And with that, I'll pass up to 2 other great managers.
Okay, great. Thank you so much. Now we're going to pass this on to Greg Felton of Full Circle Advisors.
Thanks very much, and thank you all for joining us today for this call. I'm going to start, if you could turn to the next slide, slide 2 of our presentation. I'm going to start with a bit of background on myself. First off, I have spent my career investing in credit markets, and the reason I'm today focused on the BDC market, like my other panelists, is a bit about the fact that we are in a market environment, in my opinion, where the structural benefits of being invested in private credit are substantially greater than the benefits of being invested in liquid fixed income. And having invested in the liquid fixed income markets, I can tell you that personally, I'm not a big fan today, and certainly I'm advocating getting involved in the less liquid or private credit markets. And one of the best ways to do that, in my opinion, is through the BDC market. I joined Full Circle Capital in the last year and a half. Full Circle Capital, you can see, is a public BDC. It's small. I'll get into it a little bit later. And separately, in the last 6 months, we launched an open-ended mutual fund called the BDC Income Fund. And the idea here, as you heard from the last speaker, is that it makes a lot of sense to access this space, but it's a little hard to figure out how. You can pick your own portfolio, or you can trust a manager to help you pick a portfolio. And that's what we're doing here with the BDC Income Fund. So let me turn it to the next slide and start off with the Full Circle Capital BDC. Full Circle Capital Corporation is a small public BDC that focuses on the smaller end of the market. We think that's an advantage right now because we think it's actually a pretty competitive part of the cycle to be a larger BDC. We are, as you'll see from this slide, predominantly focused on first lien senior secured, which we would characterize as a more defensive position to be in the market today. And then we're predominantly focused on floating rate investments. And so importantly, to the extent that you're focused on, is we think is reasonable to be rising rates. We and other BDCs are favoring or are exposed to floating rate instruments, which will positively perform in the event of a rising rate environment. I'd also footnote that we don't have significant floors on our floating rate loans. So oftentimes it's a fixed floor. That means that you are not necessarily going to make money the first 100 basis points of a rise. We're actually positively exposed to any interest rate rise from here. Our two securities that are public in Full Circle are the common stock, FULL. It pays a current distribution yield of 12%. And our notes, which is FULLL, which pays a 8.25% coupon and trades at a premium. Next slide, please. So I became the sole CEO of Full Circle just a couple months ago. As you heard, perhaps in my bio, I was a partner of Goldman Sachs, where I created the credit alternative platform, which we branded Liberty Harbor, and I also launched the Goldman Sachs BDC, which recently went public. Big fan of BDCs, as I've said. And I left to create the standalone opportunity that is Full Circle, and I'm going to get into some of the merits, I think, of the market today. But effectively, as I would again underscore here, you've heard there's 40+ BDCs in the market. There's a lot of different and smart ways to get invested in the space. What I've been doing the last year at Full Circle Capital is repositioning what was a very small BDC, repositioning the portfolio in a variety of different ways into larger or more defensively positioned assets. And if you turn to the next slide, you'll see that we recently completed a rights offering in March. And this is important because it was a capstone effectively of our repositioning of the portfolio. We did a number of things with this rights offering. We raised about $40 million of equity capital. Importantly, we're big believers that it's important for managers to be aligned with shareholders. And to that end, we've got, as you heard, a 12% distribution yield, and the number one question is, can we earn it? And in order to give investors comfort that we can earn it, we've agreed to waive any fees to the extent necessary to ensure that our net investment income, the BDC asset income, supports dividends. So I would say that that distribution is safe in as much as fees will be waived if dividends that are declared are not earned. Importantly as well, management committed substantially. You'll see on this slide 17% of the stock that we issued was subscribed by management. I personally own well over $5 million of our common stock today. So clearly I think I'm aligned with our shareholders. Next slide, please. I want to spend a little bit of time on the BDC Income Fund. If you can turn to the next slide, slide 7. The BDC Income Fund, as I mentioned, is a mutual fund that's designed to allow investors an access point to business development companies. In this mutual fund, we do not own Full Circle securities, given it's a related fund, but we look at the universe and provide our best position portfolio, that is to say, on what are the smart BDCs to buy. And as you can imagine, that is a dynamic question. It's a question that might change over the course of time. Our approach is to dynamically reposition the portfolio. You can see relative to a passive benchmark, which would be the BDCS, which is the Wells Fargo BDC Index. We're outperforming year-to-date 721 basis points and 680 basis points just since the inception of the fund in late November. We think that's because we've got a better approach to picking or selecting which BDCs to own, and we do think it's important for investors to be selective. Next slide, please. In terms of what the BDC snapshot might look like and what are we doing to generate our portfolio versus what our peers might be doing, we're focused on a number of different metrics. We're focused first and foremost on credit quality. What is it that the manager of the BDC is buying? We're focused on valuation of the equity. You heard John speak earlier about the importance of premium versus discount. You might find a good manager, but it might trade at a premium. We think it's important to select discounted valuations or sometimes premium valuations depending on the market environment. Sustainability of distribution is a key point. Do you think that the distributions that are declared are sustainable? Clearly, to the extent that dividend yield is not able to be earned, we think that that's a problem that will ultimately manifest in a lower stock price. So we think it's important to be focused on the earnings yield as well as the distribution yield. And then the last point I'd raise is to what extent shareholders and management are aligned. One of the challenges in the industry that's important that we think have professional managers helping to select different BDCs to own is making sure that there's an appropriate alignment and making sure that you're picking on a dynamic basis the right investments. The snapshot you can see here on slide 8, we've got a distribution yield of about 9.7% in the BDC Income Fund. On average, we own BDCs that trade at about 89% of their net asset value. And you can see the top 10 snapshot, which of course changes over time, but this is what it looked like as of April 30th. In the interest of time, I'm going to stop there and turn it back for Monroe.
Great, thank you so much. Now we're going to pass this on to Aaron Peck, again of Monroe Capital Corporation. Aaron?
Thank you, and thanks everyone for listening today. Monroe Capital Corporation is a business development company that is managed by Monroe Capital. If you could go to the next slide, please. Monroe Capital is a $2 billion asset manager headquartered in Chicago. We have offices all over the country in Boston, New York, Charlotte, Atlanta, Dallas, San Francisco, and Los Angeles, as well as headquartered, as I said, here in Chicago. We've been in business as a manager for over 10 years. We're a leading manager, having won a number of awards, including the 2013 and 2014 Small Middle Market Lender of the Year, 2013 Unitranche Lender of the Year, 2014 Senior Lender of the Year, and most recently SBIC Manager of the Year from the SBA. We have a national origination focus. I'll talk a little bit more about that as we go into the presentation. We are focused on the lower end of the middle market, companies typically with $3 million to $25 million of EBITDA, free cash flow. And we have a nice mix between sponsored deals that private equity firms own, as well as non-sponsored transactions, which are companies that are privately held and not held by private equity sponsors. I think most of you are familiar with the market environment and why there's such a compelling opportunity in the lower middle market. Banks are in a position today where it's very difficult for them to lend. With all the changes in Dodd-Frank, it's hard for banks to put out capital on a cash flow lending basis, an enterprise value lending basis. They just don't get the Tier 1 capital ratio that they need, and so it takes too much capital to lend. And so that's created a great opportunity for true originators like Monroe, who have folks all over the country looking for opportunities to go out and make high-yielding returns for their investors. We think the lower middle market is very compelling. One of the earlier panelists talked a lot about how it was an advantage to be able to do larger deals, and there was some implication, I think, that perhaps larger deals are safer. And when you think about it, it does seem like that would be a logical conclusion, but the research doesn't actually prove that out. In fact, smaller companies default less and recover better than larger companies. And there's an S&P study that goes back 15 years that shows that. It's one of the reasons we've decided to focus in this area. Our BDC is, as I said, about $250 million of assets. It's about 10%, a little bit less than 10%, a little more than 10% of our assets under management. So it's part of our business. It is not all we do, and I think that's a great benefit for investors in the business development company here. Someone might look at our company with $175 million equity market cap and say, well, that's hard to see how they can compete. How can they hold big deals? They're going to be looking at only little deals, and that's actually not true. We can do larger transactions because we manage a lot more of assets outside the BDC, and each of those assets is eligible to be part of our business development company. So it's a great benefit for shareholders is that they get the benefit of a large platform in a smaller company, which is nice. We are one of those rarefied few that are trading at a small premium to book value right now. A lot of the panelists have talked about looking for companies that trade at a discount and that being a good opportunity. And I agree, it is a good opportunity to look at the universe of BDCs and look for those that are trading at discounts. But typically there's a reason why some BDCs are trading at a discount, not all of them, but some of them. And you can't just look at the price you're paying. I think it was Warren Buffett said, price is what you pay and value is what you get. And in many cases, BDCs will be trading at a discount. The larger the discount, the larger the reason usually. Usually it's some question about whether the dividend is sustainable or whether their NAV is sustainable. Next page, please. Let's skip ahead since we're short on time. Next page. So if you look over the last 12 months, this is a piece of research put out by Raymond James that shows the BDC performance for most of the folks in the peer group. And you can see that Monroe Capital Corporation has one of the highest returns in its group over the last 12 months in terms of total return. Next page, please. And as well, we were the top performing BDC in a total return basis for 2014. So we have a history of providing good returns to shareholders. Next page, please. This is probably the most important page, though. And so some of the panelists talked a little about dividend coverage. I think dividend coverage is a good place to start as an investor considering an investment in a BDC. Because one of the reasons some folks are trading at a discount to their NAV is because there's some question about the sustainability of the dividend. And how are dividends sustainable over a long term? They're sustainable if you earn them. And so as you can see, Monroe Capital is comfortably covering its dividend today at 140% over the last most recent quarter dividend. We did actually raise our dividend last quarter, up a penny from 34 cents to 35 cents. A number of my peers have been forced to be in a position where they've had to lower their dividend. And some of these folks are covering their dividend only because they've lowered their dividend. And it's the right thing to do. I don't question that decision. I think if you can't sustain your dividend, you should lower your dividend. And you can't sustain it if you don't earn it. So I think when you're thinking about an investment in the BDC space, it's important to look at discounts and to consider why something's trading at a discount before you consider that investment. And also look at the folks that are in a position to earn their dividend and think about the fact that a small premium may be something worth paying if you're getting value from it. And where you get value is getting a nice dividend yield. We're at about a 9.7% dividend yield today, a small premium to book value. And you can see that we're more than earning the dividend, which creates a pretty nice opportunity for the possibility of some positive dividend momentum as we just raised the dividend. Next page, please. Since the inception of our BDC, we have grown our net investment income on a per share basis about 23%. We did have a small tick down in NII last quarter. That was largely due to the fact that the fourth quarter of 2014 had some unusually high fee income. So it was expected that we would have a slightly lower NII for the first quarter of 2015, which we did. One of the panelists talked about, it's important to invest in BDCs that have been through a cycle. You don't know how a lot of the BDCs came out post-recession. You don't know how they'll do. There's no history. And I think that's a fair point. I think it's if you look at a manager that's a new manager, that a BDC is a vehicle for them post-crisis, and they don't have a long history, it's possible that you could find some people that don't really, haven't had an experience of going through a credit cycle. That's true of our BDC, but it's not true of us as a manager. We've been operating in the lower middle market for over 10 years and have been through a number of cycles. And some of the firm's best performance actually was during this crisis, where we had over 20% returns to some of our investors on certain of our funds. So we've had a great history of investing through the cycle, and I think it's important to get a manager with a lot of experience. And when you look at the BDCs that are post-crisis, it's important to look and see who's got the experience from their other vehicles if they don't have it in the BDC themselves. Next page, please. This is another thing I think that's really worth looking at. And I talked about the first two graphs on this page, which talk about dividend coverage versus the mean and total return versus the mean. But the next two pieces on this page are really important as well, which is Monroe is 94% senior secured first lien lending. And our origination in the fourth quarter was 100% first lien lending. And when you look at the peer group of BDCs, they tend to be skewed towards first lien, but are not quite as high as we are in terms of percentages. More importantly, the yield that they're earning on those first lien assets is considerably lower than the yield that we're earning on our first lien assets. And the question is why? And the answer, I believe, is we have those originators sitting in those offices all over the country, going out and finding unique opportunities for Monroe. And these are folks that are focused fully on just doing that. And I think it creates a really nice proprietary deal flow. About 1,500 deals a year we look at, 1,500 to 2,000 a year. And so we see a lot of great proprietary opportunities to lend, and you compare that to a lot of BDC managers, and their originators are typically sitting in an office somewhere between Park Avenue and Fifth Avenue with a phone in front of them, and that's how they go about originating. And a lot of them are focused heavily on the sponsor part of the market, calling on private equity firms. And we like private equity firms as well. We think that's a great place to find deals, but it's not the only place to find deals. And often when you win a transaction on a competitive basis with a private equity firm, you've lost, because in many cases you're providing something that is maybe the lowest pricing and the weakest structure, and that's how you can win. And so we don't really like that space, and so therefore we don't like to be competitive on private equity deals. We'll go out and do deals with private equity sponsors where we think we can have an advantage and have a reason to win that's other than just pricing or structure. And so with this kind of yield on our originations, we think that shows that our dividend can be sustained. Next page, please. And this is some of the data behind that. We've got all the BDCs that were tracked by Wells Fargo that are under $1 billion market cap. We've compared ourselves on an origination basis to those, and you can see we're just generating a much higher yield than most of them on our first lien assets. So a safe, secure portfolio of first lien assets. Next page, please. With that, I can turn it back. That's all of my prepared remarks, and can turn it back to Patricia.
Great. Thank you so much, everyone. I'm just going to remind the audience, if you have any questions, feel free to jot them in the questions box, and we'll run them by our panelists. So I have a couple questions that came through so far. This one, I guess, we'll direct towards Greer. We have a question. Just curious, what is the take on the current trend of REIT BDC companies rolling out closed-end interval funds like Griffith's GRIEX? Do you think there's a market for such vehicles, and how do they stack up against BDCs, in your opinion?
Sure. So we actually have a couple of closed-end, non-traded funds. We actually pioneered the first in the industry for that have a lesser load than their non-traded BDC and non-traded REIT brethren. There's several differences there between non-traded products and their traded brethren in the registered world. Load is a big one. The loads are about 10% for the REITs and BDCs, about 8% for the CEFs. Liquidity is another big difference. Those are going to be less liquid. The word interval was used. In some cases, the redemptions are capped at the DRIP. In other cases, there's a little bit more liquidity available, but more often than not, then there's a liquidity event that's required, several years down the road. I actually think there's some interesting, innovative ideas, some of which we're working on, pertaining to truer interval funds with greater redemption ability that mix in some liquid assets with the illiquids. But that's something for another day in terms of the detail. So a lot of interesting innovation going on out there. Right now, the vast bulk of the capital raising action is occurring privately with the non-traded. I think non-traded BDCs raised something like $5 billion in 2014, which was 5 times their listed brethren, which is a little bit of a head scratcher given the illiquidity and the loads. But makes sense when you consider BDCs below book are not going to be significant or at all issuers of equity.
Okay, great. We have another question that came through here. Can you explain why you see a higher risk-adjusted yield for BDCs over CEFs and result of structure selection? So I'm not sure who wants to take that one.
I guess I'll try, John Cole Scott. So you mean the higher absolute yield, I guess? I mean, because, again, conceptually, BDCs would need to have a higher yield than like a senior loan closed-end fund, because their loans are generally bigger companies, could be more easily followed and analyzed. Usually companies in the senior loan closed-end fund regular market have also other debt in the market that trades easily. And so BDCs, because of, again, a little more leverage, private holdings, again, they make more money on doing the deals because the deals are harder, and in the public markets require a little bit higher yield. The average debt BDC is about a 10 yield right now, and the average senior loan is about a 7 yield in the traditional market. Hopefully that answers it well.
Okay. We actually have another question here. Can a BDC qualify as an emerging growth company, and what are the benefits? Oh, I'm sorry. Before we go on to that, I think Aaron was going to add to your comment.
Yeah, I was just going to add, I agree with what John said about the BDC yields, but I also think that the part of the answer to the question is that they shouldn't. I mean, they shouldn't be trading, in my opinion, BDC should not be trading at the yield premium they are to the regular closed-end fund market. I think that the BDC market as a whole should be trading at a premium because BDCs are providing considerably more yield opportunity, and frankly, that yield should be traded down. You know, people should be buying these companies on the whole and bidding them up to a premium because they've shown that they're a sustainable business model, and they've shown that the risk is not considerably greater compared to the yield than a lot of the other vehicles out there that provide yield. So when you think about you know, bond funds, for example, high yield bond funds, you know, the ratings on the types of assets that we would put to work as BDC managers probably are not that dissimilar to a high yield bond fund's ratings, and yet we're typically providing senior secured first lien assets, and bond funds are typically in unsecured assets, and yet there's a 500 plus basis point premium on what we're doing. And so I think that the market just needs to become a little more mature, and people need to understand that the BDCs are like, perhaps a lot more like how REITs were looked at, many years ago when they were not trading at premiums, but tended to trade at a discount. And over time, REITs were bid up and yields came down, and I would expect the same to happen over time for BDCs. I think there's a great opportunity here for investors.
Okay, great. We have another.
The other question about emerging growth company, which is a Jobs Act question. Mm-hmm. 40 Act companies are not allowed to be emerging growth companies, and BDCs are, and CEFs are 40 Act companies. And we know this also because we're doing 3 spinoffs right now at PSEC, Prospect Capital Corp. We're spinning off our structured credit business into a CEF structure, but the other 2 spinoffs, our online business and real estate business, are into non-registered investment company structures, a REIT, and a proprietary corporate structure. Mm-hmm. For those 2, and we're actually filing those under the Jobs Act as emerging growth companies. And the benefits you get are you get to do your filings behind the scenes with the regulator without showing your hand to competitors. We're availing ourselves of that. You get benefits and relief from certain parts of SARBOX. There's a few benefits when you're talking about IPOing companies as we're doing there, but it's less relevant to our core discussion of BDCs and CEFs.
Okay. I'm not sure which one of you want this one, but how many other BDC mutual funds are out there besides the BDC Income Fund was the question we got.
This is Greg. We know of one other BDC mutual fund out there in a mutual fund format. Obviously, John has a UIT, and there's other UIT products out there. But in terms of open-ended mutual funds, I think the AR Capital is the only other vehicle we're aware of.
Okay.
And this is Greer. We remiss me not to tell folks that Prospect has a UIT as well, along with our esteemed Mr. Scott here. Which we distribute through In Capital, and we actually did the first BDC UIT going back to last June, and we're on a number of different systems, and it's doing pretty well.
Okay, great. I have a question here for Aaron. How do you originate assets, and what differentiates your origination from other BDCs?
Thanks. Yeah, that's a great question. So we talked a little bit about our national footprint, and I think that we focus a lot more than a lot of other BDCs on really looking for proprietary opportunities that are sourced directly through relationships. So we have, close to 20 originators sitting in these offices all over the country that go out into the local markets and spend time in those markets developing relationships. They've come up through those markets. They've always worked in those markets. And so you can sit in New York or on a coast and try to call on folks in Atlanta or Dallas, and you can be successful doing that. But it's much better when you're in those markets and you're seeing the same people at all the same conferences every week, and you're playing golf with those people, and you're talking with attorneys and accountants and financial advisors, and have those relationships. It makes it a lot easier and a lot more, I think, beneficial to do that, to find deals, and the hit rate on the deals we find through that is much higher. And so we're really focused on that, and it's a very expensive proposition for the manager, but we think it shows in our results that we're able to generate excess yield and find really nice opportunities through that national footprint. And we think that's the best way to go out and find proprietary origination. At the end of the day, people are getting paid nice management fees to manage these vehicles, and some folks out there in the space are not really investing in the infrastructure to go out and find unique opportunities instead of just buying assets off the street and taking pieces of second lien transactions from Wall Street firms. And that's okay. You can do that with some of your capital, but if that's your pure origination strategy, I don't think that there's a lot of alpha in that long term.
Okay. I have another question here, actually. I'm not sure who wants to take this one. It says, am I missing something about BDCs? If the economy muddles along and we're not in a better place being a secured debt holder than being an equity holder? So I guess what they're asking, would they be better off holding equity as opposed to, if they're better off holding secured debt as opposed to being an equity holder?
This is Greer. I'll try that one. Well, I think in a slow growth economy, credit is arguably a better place to be than equity. You're not going to have as much equity upside because the economy isn't growing as swiftly. And if you're examining public equities, then it's already likely more than priced in. Going back to my opening remarks about what increasingly economists are saying about public equities, SONs, BDCs getting overheated. On top of that, from an underwriting perspective, and we've been at this for several decades as careful underwriters to prospect, it's easier to underwrite credit in a slow growth to no growth economy, and capital structures don't tend to get as carried away out there in the marketplace. And that's the kind of environment we're in right now. It's much easier to underwrite now than back in 2006 and 2007 when you had more significant GDP growth, more significant corporate EBITDA growth, and then of course on top of that with others, the leverage structures that were toppy on top of a toppy peak EBITDA, which created a double problem when the so-called Great Recession hit. Here, more moderate growth is a big help. The other help is that while a lot of folks in the private sector, let's say ourselves included from time to time, like to rail against regulation, the leverage lending guidelines really are restraining in a helpful way leverage getting too carried away on the broadly syndicated side of things, which should help reduce the risk of defaults. Earlier, one of the panelists talked about middle market being superior to the broadly syndicated. We're very agnostic on that. We think both are excellent places to be. We think closed-end floating rate loans are excellent values as well. So we're not saying pick one or the other. Both are terrific and with much lower expected defaults in the next cycle.
Okay, great. I have a question here for John Cole Scott. What are the options for investors looking to add BDCs to their portfolios and research options?
Yeah, so that's been partially covered. I mean, there are actually 3 BDC UITs, Prospects, Smart Trust, one we work with, and then Advisor Asset Management has one. Again, there are only 2 open-end funds that we've found. There's also First Trust has a closed-end fund, that's FGB, and then there is, I believe there's a firm on the West Coast that's more of a hedge fund, long-short version of the sector. So a lot of those options available, but then there's also some free research resources. There's a BDC Buzz who we know pretty well that writes one-man band, half the time in Thailand, half the time in Seattle, but covers the sector on Seeking Alpha and has a small price tag premium research service. And then BDC Reporter which is part of that hedge fund on the West Coast, covers it pretty actively and well. And then if you're an advisor and you're, Wells Fargo has a good BDC team, Stifel Nicholas bought KDW. They have a great research that we enjoy reading. And then occasionally the other firms have their finance people put out some good stuff. So if you've got brokerage relationships at a firm with analysts, definitely double check if you have any access to some coverage that might be helpful.
Great. Okay, we have a question here for Aaron again. Do you make use of the 30% non-qualified bucket? Why or why not?
That's also a really good question. Some of the folks on the phone may not be familiar with some of the rules around BDCs, and I won't get into great detail because it's complicated, but BDCs are required to have 70% of their assets in what's known as the qualified bucket, which is going to be typically the stuff we've been talking about, lower middle market or middle market loans. Loans to private companies are all qualified as well as equity. What is not considered not qualified is some of the other assets and things like CLO equity or real estate, things like that will be considered non-qualified. And some of the BDCs have made a point of focusing on that area because they think it provides some differentiation, and I think that's a valid opportunity. I think you can look at BDCs and decide what flavor you like. We, to date, have not made much use of that bucket. We like a lot of the assets that other BDCs are putting in their non-qualified buckets. We're just not sure they're appropriate for BDCs. For example, we're big fans of CLO equity. We think buying into structured vehicles like CLOs is a great investment, but I'm not sure that most investors that invest in BDCs understand that well. And it's okay to put some of that in your company, but if you have a big amount of that CLO equity, I think you're gonna find that a lot of the investors don't really know what they have. And in an environment that could be negative on a credit side, CLO equity tends to take pretty hard marks, maybe unfairly. I would argue unfairly because I think it's good value. But I do think it creates some mark-to-market volatility, and then in some cases those equity cash flows turn off for some period of time and don't create cash flow, and that's difficult for a BDC to manage through. So we to date have not made extensive use of a 30% bucket. I do think that you can take a look at each BDC and try to get a feel for what they're doing with that bucket if they're using it, and decide if you like that strategy. And I think it can be a great strategy if the investors, as long as the investors know what they're getting.
Okay, great. Question here for Prospect. Recently, BDCs have traded to a discount to book. Why has that occurred, and what are the implications for the middle market finance industry?
Sure. I think that 2014 and early in 2015 have been a very difficult and negative psychology for BDC investors, starting with in the first half of last year, the removal of BDCs from the broad-scale equity indices because of a requirement that ETFs that hold BDCs have to report higher than actual expenses. It's an insane rule. It makes no sense, and the government's not going to change it, unfortunately. And it rippled through and had the effect of the removals. That impacted us in probably the most painful way because we were in both the S&P 600 as well as the Russell 2000. Most of our brethren were only in the latter. So I think we had something like 18% of our shareholder base was index funds that had to immediately be forced sellers. And that's a significant reason why we have the discount today, which of course offers a wonderful, attractive entry point for investors right now from a value standpoint. But going back to the overall industry, you had the index removal in the first half of the year, you had the energy credit scares in the back half, coupled with retail tax loss selling, several just painful negative psychological blows, especially to retail. A reduction in the institutional bid commensurate with the removal from the indices. And then a lot of confusion as well here in 2015 pertaining to how BDCs perform in a rising rate environment with kind of a muddled understanding, which hopefully webinars like this one can help investors to understand that BDCs should perform quite well. You look at our business from 2004 when we went public to 2007 when the Fed started loosening. During that tightening period from 04 to 07, we did extremely well, as did our peers in the industry. So you can look at history as a positive guide to be helpful markets don't say this dislocated forever. And anyone with a value bone in their body should be aggressively looking at BDCs and scooping them up right now.
Okay, great. I have a question here for Greg. Since the discount to book in some BDCs is so great, why not buy back the shares by selling off lower yield? Do you have any thoughts on that?
Yeah, sure. It's a fair question, and Greer just spoke about the compelling value that exists in BDC equity, and we agree. I think all the panelists seem to agree that there's a lot of value in the market, and naturally the question is should the managers take advantage of that? And I think that has been an issue and question raised among many of the sell-side firms. I think it's a legitimate question to be asked. I think one of the things that could make a lot of sense is a repurchase of shares where it's accretive to your book to the extent that the manager has excess liquidity and perceives that the ROE of that repurchase is more compelling than acquiring a new asset. So I do think it's a very legitimate question and that should be asked of those managers that are trading at a discount, and see what responses you get. As I mentioned before, we as an investor in BDCs are pretty focused on making sure there's an alignment as between the manager and the shareholder. And one of the obvious things that we think investors need to be mindful of is the fact that as BDCs get larger, the BDC managers benefit from that, as they do in every asset management business, and so that's not unique. But it's important to ask the question about alignment and the degree to which shareholders are benefiting as managers are benefiting. So there's no one answer for any manager, and I won't speak for particular issuers, but an appropriate question to be asked. I'll echo the sentiment as well again, which is we do think that the stocks of many BDCs at discounts represent value, and so it's not that shareholders or prospective investors shouldn't buy, but you might want to ask the manager whether they're buying as well.
Okay, great. And I believe Aaron wanted to add to this as well.
Yeah, just on the question about buybacks, I think it is a very good question. As Greg said, it's a question that should be asked, and also it's a question that should be answered by managers. And just as on a personal note, over a year ago, we were trading at a pretty substantial discount to book value, and we sat down with our board of directors and said, what should we be doing about this? And we, like many managers, had the desire to become larger and had the desire to grow our company, but we also felt a great responsibility to shareholders to recognize that we thought we were trading at an unfairly low price, and we put a buyback in place. And a lot of BDCs, I shouldn't say a lot, several BDCs have put them in place, but not too many have used them. But we actually did. We used most of the buyback that was authorized by the board, and we bought in shares at a discount because we thought that was the highest and best use of capital. It was a higher return than it was where we could put the assets out. And also, it was more than just that, though. I mean, you can always look at that analysis, and some managers will argue, listen, I want to have the flexibility because I don't know when the market's going to widen, and there may be opportunities for me to put that money to work. And if I use that money to buy back shares, I'm not going to have that capital available when returns are wider than they are today. And that's fair. But at the end of the day, you also need to show shareholders that if you've been a serial issuer and you've been out raising money over the years at premiums, that you're okay considering and actually going through with buying back shares when you're at a considerable discount. I think it's a good signaling event for shareholders. I think it's a good return trade for the company. And unfortunately, the only person that really doesn't benefit is the manager, because your asset pool shrinks. But sometimes you have to take a little pain in order to do what's right for shareholders. I think it's a good thing, and I wish that more BDCs had the discipline to put them in place and use them.
Okay. And John, you wanted to add to that?
Yeah, I was going to say that, from our data, we just added last week into our data project, getting us to about 110 now data points, both secondaries for BDCs, repurchase. So I can say 14 have them in place. We're still filtering through how many of them actively have used them, but about a third of the sector has them in place. Definitely support it. The comment on it reduces the size of the firm. I'll say if you keep investors happy, if you stabilize NAV, which that's accretive to, if you maintain your dividend, discounts tend to go away, and then you can create new equity down the road. Pretty much everyone has buybacks, has also done secondaries, of course, very common for the sector. Just want to add my vote of yes, we agree with that completely.
Okay, great. I have a question here for Greer. Some BDCs are now looking at spinoffs as a way of creating shareholder value. Why are they doing this?
Sure. We're innovating this as a method to unlock value, along with a lot of other firsts and innovations in the industry, like doing the first BDC acquisition, the first to issue a lot of the liabilities, et cetera. We've done a comps-based analysis of individual businesses. We've got about 9 in our multi-line strategy, including several control-oriented ones. And we've looked at comps in non-BDC structures that are trading much better than BDCs are. The structured credit comps are at about a 10% premium to book value. The real estate comps are at a 50 to 100% premium. As long as I can remember, $1 of yield coming out of a REIT has been valued at 50 to 100% more than $1 of yield coming out of a BDC. I think part of that is tax. Part of that is because REITs, equity REITs, have growth attached to them that credit books and BDCs do not. And we've got a buyout book that can grow. And then we've done comps-based analysis on the online business, where you have Lending Club and OnDeck trading at 4 to 8 times book value. So obviously there's a tech-infused excitement for those businesses. But even non-bank consumer finance names regularly trade at 2 to 3 times book value, which almost no BDCs ever hit or haven't in a decade. So we think there's a huge opportunity to unlock shareholder value that's uniquely available to prospect and prospect shareholders, because we're the only BDC in these types of businesses too.
Okay, great. I have a call here for John. What are the biggest risk factors for BDC investments?
I think we've kind of touched on it in somewhat, but I think people worry, what's going to happen. And so, well, obviously managers have to write good loans, right? And so that at the end of the day, you have to see that fair market values are done well and that they set the loans up with provisions. And it's way too hard to explain it quickly on this call, but just talk to management, look at their research, get a handle on the process. That's number one. And number two, it's what is the volatility? Which we're not worried about the volatility. It's opportunity in the closed-end fund neighborhood, but knowing that these things can move around a lot. We use the fancy phrase they're less homogenous than their traditional closed-end fund brothers, which is just a way to say you really need to know when to get in, when to get out, and be more opportunistic in them. And so good loans, fair market write-downs. Remember, they have an independent board of directors that's accountable to shareholders for doing these, and so many good groups in the sector that do great work. And just remember that you just pick good entry points, pick good managers, and stay a little bit diversified, because it's hard to it's hard to own one BDC, in my opinion.
Okay, great. I have another question here for Greg. Do you have any comments about what is going on with American Capital, ACAS?
Yeah, I mean, ACAS has been a name that's been in restructuring for quite some time. It's a business that is in transition. I won't really forecast, what's going to happen there, because I don't think that would be appropriate. But what I would say is this: our BDC income fund is focused on income-oriented BDCs. That is to say, we're focused on fixed income-oriented BDCs, again, that have sustainable distributions. And so, just dovetailing on the last question, I want to make sure I pick up on that as well. Risk factors for BDCs are, can they earn the distribution? In other words, is income going to be consistent with the distribution level? And that's a key thing that you need to be focused on when buying BDCs. As it relates to ACAS, the company is being transitioned into. It's going to spin out and ultimately create different vehicles with different profiles. There's a big equity orientation as well as a migration to fixed income. And so I would tell you that it's an event-driven opportunity that, from our perspective, is one that is outside the scope of where our income fund focuses.
Okay, great. I have a question now for Aaron. What percentage of your assets are first lien, and why do you focus on first lien origination?
Great question. About 94% of our assets today are first lien, and you have to really, I think, as an investor, take a hard look. And Greer talked about this in his presentation as well. I think you have to take a really hard look, and as did Greg, actually, all three panelists that run BDCs here talked about the focus on first lien. And I think it's important for investors to understand that not all BDCs are are the same. That there are a number of BDCs that focus almost predominantly on subordinated lending or mezzanine lending, and that's okay. You just have to know what you're getting. And I think it's important for people to understand the risks that you take on when you buy one of these companies. Not every BDC is created alike. And so you have to understand that if someone is focused on subordinated lending or mezzanine lending as part of their BDC, and that's, you know, majority of their assets, and that's how they generate yield, that there's more risk to that. I mean, it's just a fact of life that those mezzanine loans are going to typically be unsecured. They're going to be subordinated, and you know, they're likely to get hit a little harder in a negative credit environment. And so at Monroe, we certainly will do second lien and mezzanine lending from time to time, and we like that space from time to time. But the predominance of our assets are focused on first lien senior secured lending because we think it's the safest place to be, and we can still generate high enough yields in order to do that. And a lot of folks, you know, can't in the first lien space, and so they don't. And so it really comes down at the end of the day to whether you can or can't originate first lien assets to generate the commensurate yield to pay a high dividend.
Great. Another question here for John. There are over 40 debt or loan-focused BDCs. Who do you group them for analysis?
Yeah, so really, you know, we kind of put them in the, you know, 4 major buckets. You know, there's kind of the deeply discounted BDCs where there's either been energy concerns or dividend concerns or just underwriting concerns over time or not a stable NAV, and those tend to have about 20 discount right now as a group. Then there's like a middle group where it's usually just a little bit of portfolio concerns or maybe some interesting stuff in their history, like a little return of capital because of how they incepted, and those are kind of that mid, you know, 10, 5 discounts. Then there's a neat group of, you know, small premium BDCs where you're not paying too much for them, but they're usually higher growth of net asset value because they can keep adding equity. You're getting a lower yield with them, and there is some discount gravity risk, but it's another neighborhood. And then because we're closed-end fund investors, I just can't buy a BDC for over about 15% over book or 15 premium. But there's a group there, good management. I mean, I can maybe buy them tactically for a short time for an SMA client, but, you know, just really challenging to buy them because, you know, I just have trouble paying $1.20 for $1 of assets, even though I know I can't create it any other place than this market. It's just really hard with other good options in the sector. So those are the 4 major groupings of just how we categorize BDCs.
Great. Okay, we're going to have time for one last question, and I will just note that if anybody had any questions that were asked that were not answered yet, we'll be sure to follow up with you after the webinar. But just in the interest of time, I have one last question, and this one is for Greer. Actually, it's kind of a 2-point question. What is the likelihood that BDC legislation passes this year to allow 2-for-1 leverage? And also, some BDCs have expanded beyond corporate lending to other yield-oriented strategies. What are those strategies and what are driving their growth?
Great, thanks, Patty. The BDC legislation is something to watch as a positive driver for our industry. In case folks aren't familiar, BDCs are currently limited to 1-to-1 debt to equity, which includes, by the way, preferreds being counted as debt. And the legislation, which we and others have been working on for a couple of years now, which is getting some nice momentum, would allow BDCs to go to 2-to-1 debt to equity and have certain types of preferred carved out of being classified as debt. We think this is a positive move. There still would be a leverage cap on the industry, which is protective to investors. And remember, banks are typically levered 10-to-1, so we're talking about a far cry away from the more leveraged crowd out there in financial services. We hope and expect to get through the House this summer, pivot to the Senate, and have a bill signed by the President by year end. And the ability to lever prudently assets that are regularly levered much greater than 1-to-1 in the private markets, the non-registered markets, should be a significant boost to return on equity for BDC shareholders. Of course, things will adjust stock price-wise upon announcement, so the time to buy BDCs is before that gets announced, not after. On the second question, I think commoditization is a significant concern BDC shareholders should have out there. There are 30-plus BDCs, 90% of which do pretty much the same thing, and compete on fees, compete on commoditized yields in the marketplace, and pay attention to true barriers to entry and value add out there. We work very hard and have the largest team in the industry because we're focused on other businesses. They're just a heck of a lot harder, like buying companies, operating buyouts, financial buyouts, or real estate deals or buyouts. When you own a company, it's about 10 times more work, maybe 100, compared to merely making a loan to that company. Think emergency board meetings on Saturday mornings rather than relaxed soccer games watching your kids when you're an owner of a business. So that's what we do. It's a return on effort world, and we think we, and as well as our fellow panelists who work very hard at what they're doing, are trying to deliver value to shareholders every day.
Okay, great. Again, we're out of time at this point, but I thank all of our panelists for being part of this presentation. I thank our audience for listening. We will have a replay of the presentation, and we will have it transcribed as well. For anybody that was looking for CFP credits, again, just email us at events@pristineadvisors.com, and we'll take care of that for you. You can find out more about our upcoming webinars on our website, cefnetwork.com, under the Events tab. And again, I'd like to thank Greer, John, Greg, and Aaron for your time today and for this wonderful and informative webinar. Thank you again.
Thank you, Patty.